Hey guys, Kevin Bopp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income producing real estate investments. And our guest for this week's show is multifamily investment expert Bernie Leas. Now, Bernie has an extensive background running high performance teams at scale and successfully manages multi-million dollar operations worldwide. He began investing in real estate just a short 4 years ago, and like most of us, made his first investments in the single family space, but quickly realized, the various efficiencies that exist in larger properties and transitioned to multifamily in 2019. He co-founded and launched Elemental Equity, a Boise-based commercial real estate investment firm that focuses on helping successful W-2 earners achieve financial freedom through real estate investing. So, guys, it's my honor to welcome my guest for today's show, Bernie Leas. Bernie, how you doing, my friend?
Well, Kevin, thanks for having me. Appreciate
Yeah,
it.
excited to have you here. Absolutely. And as we were chatting about before we started rolling into it, you've got a not just interesting background as far as like professional career that is before dove into real estate, but we talked about you being an Alaskan fisherman for 6 years of your life, commercial fisherman. And so I'm not going to steal your thunder here, my friend, but maybe take a few minutes if you would, kind of back up a little bit, tell us a little bit about yourself, where you grew up, how you've ultimately found yourself into real estate. But I'd love to hear a little bit about that commercial fisherman gig that you did for 6 years.
Yeah, sure, of course. Yeah. Well, my dad was in the oil business back in the 80s. And so he moved the family to Alaska. And that's kind of where I grew up with my mom and dad and two sisters. And just, through some network with some friends, neighborhood friend, he had an uncle who had a commercial fishing business, about an hour and a half flight outside of Anchorage, Alaska. And so when I was 12 years old, he invited me out for a couple of weeks, test the waters. And I spent 6 summers out there, fishing commercially for him and slinging fish around and in the sand and the wet and in the cold, that kind of stuff. And as a 13, 14, 15-year-old, it's like, man, this really sucks sometimes. But as an adult, you look back and go like, those are great lessons to learn. And it made you appreciate the things that you do in life, down the line. For sure.
They probably call that child abuse today. If you send a 12-year-old out on a commercial fishing boat, but no,
It was fun. Yeah. Well, but, as a kid though, three-wheelers and driving trucks and stick shift trucks on the beach when you're, 13 or 14, it's a pretty good life though.
No, that's fun. Fantastic. So, you're still working a full-time job today. I know you're in the e-commerce world, and then ultimately found real estate, roughly 4 years ago. So maybe tell us a little bit about that path and, what led you to real estate.
Very similar to a lot of people, Kevin, just you're looking for, gosh, I need to make a little more money. I'm looking for, things for retiring, pay for kids' college, things like that. And my wife and I were talking through it, and we'd been investing in the stock market and things like that, but we wanted to do real estate for a while. And, you kind of kicking the tires around it and you just don't take action. And so we finally decided, let's just do it. And so we did a HELOC on our house, home equity line of credit, pulled out some cash, and did like a lot of folks did, right? We bought a couple of single family homes in Indianapolis, Indiana. And we thought we were living the dream, right? We're like, holy cow, this is good. This is easy. We're making good money. But then 6 months later, you're like, gosh, I'm out of my own money. and the houses are cash flowing okay, but not cash flowing enough to buy another house. And so for us, it was like, gosh, how do we scale this and do something at a larger scale and give ourselves a little bit of an additional income stream that is providing more income than what we're getting with single family house. Mm-hmm. And so we started to dive into different networks and things like that. And we kind of fell into a network we'd been looking at for about a year. They were focused on multifamily. It has been something we talked about for a while. And so we finally pulled the trigger about 3 years ago. We said, we have a house. It's got a lot of equity in it. And so let's sell the house and use that as a way to buy apartment buildings. And so we put the house in the market. And of course, my wife found out she was pregnant. And we're like, what the hell are we doing here? And so we kind of working through that phase, but we kept to it. And, in talking to some people in our network, a guy at work I work with, he and I actually co-founded Elemental Equity together, Mike Shaughnessy. He dived into it as well, too. He really believed in multifamily as a great way to create income. And so he sold his house as well. And so, here we are, two guys who are homeless almost, not really homeless, but you get the deal. And that was our seed capital to go out and look for our first deal. And we spent about 2 years, Kevin, until we finally closed our first deal in February of last year.
Okay, fantastic. Well, let's talk about that then. That's obviously the foundation to where you're at today, that very first deal. And so give us some of the particulars behind it, where it's located, the size of it, what attracted you? Like what made that be such a great opportunity versus probably the many others that you passed over, over the last couple of years?
Sure. Well, Mike and I had known that we were going to pull down a deal that we couldn't do ourselves.
Mm-hmm.
And so we would be the major capital investors in it, but we also knew we had to syndicate it. And we had been creating a network of friends and family who had said, hey, if you find a good deal, I want to invest in it if it's the right thing. So our criteria was a good market and a good asset. And so we've been looking at Tennessee for a while. It's like the number one U-Haul destination, I think, for the US in terms of people moving there. And we love the Nashville MSA, Middle Tennessee, great area, really landlord friendly,
Mm-hmm.
and just a really great business environment as well too. And so we've been kind of just slogging through, it is, you're underwriting hundreds of deals, you're looking at stuff, you're getting frustrated after a couple of years. But we found one in a small town called Tullahoma. It's about 70 miles outside of Nashville. And we liked it because it was in the path of progress, where we knew like in 5 or 6 years, it'd be a really, really hot market.
Mm-hmm.
But it was an A-class asset. It was only 3 years old. It was run by mom and pop. And so the rents were way below market.
Mm-hmm.
And we knew that if we invested in this and took people's money in it, we weren't going to have that like going back and, hey guys, by the way, I know we're only 12 minutes into it, but half the water heaters are out, or all the ACs need to be replaced, or the roofs are leaking, things like that. We knew that wouldn't be an issue. And we wanted to make sure that we had a conservative, safe investment that we could build credibility with our investors. And then down the line, hopefully expand upon that. So that's kind of what our criteria was. And we found a really great asset there. It was 16 units. It was in the ballpark pricing that we wanted to. And rents, Kevin, were probably around $200 to $300 below market rent.
Mm-hmm.
And so we knew there was a great upside without having to sink a bunch of money into it as well.
How have you guys been able to? And I'm making the assumption that your business partner, does he also live out in Boise, or
He does, yes.
Okay, got it. So, long distance investing. I don't know the exact distance, but Boise to the Nashville area, it's got to be more than 1,000 miles. Probably, probably 1,500, or maybe not. Maybe it's 1,000 miles. But either way, it's far. It's not. It's not a hop, skip, and a jump. We'll leave it at that.
No.
How have you guys been able to, acquire these assets? And we can keep on this first one, again, given that's a foundation, but you identified it, but then actually executing on it and taking it down and executing on that value add plan. How have you been able to achieve that with that particular property?
Really, it was for us is that those first 2 years, if we were looking for a deal, Kevin, it was frustrating because we weren't getting deals. But during those 2 years, we were building out our network of people in that market, right?
Okay.
We knew Tennessee, that's where we wanted to be at. So we started to find people who were successful in that market. And we were actually able to hook up with a guy based out of Nashville who'd been investing for over 10 years, very, very successful in the single family space, was starting to branch out in multifamily. And he was open. He was like looking for partners as well, too. He wanted to partner. And so that gave us the comfort of having somebody with boots on the ground and who also could help us pass the smell test for deals, which is like, it looks great online, right? And the brokers, of course, say there's tons of upside, all that kind of stuff, right? But he would be able to tell us like, I know the market, it's not a good market, or I know that area, it's a really good area. That's a great side of the town, things like that.
Mm-hmm.
That really helped give us comfort. And for our investors as well, who are also not in Tennessee either, we were able to tell them like, hey, we have a guy on the ground who's actually toured the property, and here's what we found, here's what we like about it, and here's why we're excited about the opportunity, versus saying like, it's a really cool thing, it looks good or great on paper, and we're hoping it'll cash flow out in 6 months, right? That's the harder sell for us.
Sure. Well, and the reason why I asked that is with a lot of the larger, once you get to a larger scale, the options as far as professional property management companies is much greater. You have much more of a selection of working with not just a PM firm, professional PM firm, but someone that's got the resources associated with executing on a multi-door value add plan, right? Doing renovations to many units at one time. And, you kind of fall in the no man's land, when you really have under that, 80 to 100 units, and depending on the marketplace. But I would say with 16 units, you end up, your options probably are more leaning towards a property management company that more specializes in single family, investments rather than that of large scale commercial projects. And so again, how have you guys, is it the partnership that's local there? Is that the individual that's spearheading, the renovations and has the eyes and ears there locally, or how's that being managed?
No, we have third-party management for all of our
Okay.
properties. And
Okay.
so, we took over the same PM on that first deal that was running the property ahead of time. And he was doing a good job for us, but we had to part ways earlier this year. It just got to the point where they weren't meeting the expectations of our business plan. And so we brought in another company that does in that area and specializes in the small multifamily properties. So under 50 units, they've got about 900 units in their portfolio. So it gives us a way to kind of share resources at
Mhm.
scale for them, and also give us that kind of that broader marketing presence in the marketplace that we wouldn't have had if we tried to do it on our own.
Yeah. Have they been able to meet your expectations with regards not just the day to day, but also helping you guys execute on and maybe you don't have a value add plan. Maybe it's just truly, getting rents up. And I was making assumptions that maybe you might be doing improvements, to actually realize, what the real market rents were. And so maybe explain a little bit more as to what the plan is with that property and ultimately what other role is that PM company playing outside just the day to day.
Yeah. The first one really there's no value add. We were lucky, right? It's a brand new property. It's in really, really good
Okay.
condition. And so it was just, it was the mom and pop ownership where occupancy was priority 1, 2, 3, and 4. And then getting rents higher was maybe down in around the 9 or 10 on the priority list. So we were able to come in and sit there and say, like, we've got a great value, a great property, right? It's a tremendous value for what the dollar we're charging. And because we're not in that direct high end kind of that market, really close to Nashville, you can get a lot more square footage for the price that we're charging, even at the higher rents.
Hmm.
So they've been the secondary one, the second PM that we brought on, Kevin, has been helpful in kind of pushing occupancy at a faster rate than before. We do have a second property though that's under management that's about a couple miles down the road, and that is a value add proposition, right? And that's something we're putting a lot of renovations in, and they are the ones that are spearheading that for us. We're using their vendors. We're making sure that they're project managing for us on the daily stuff and holding our vendors accountable to meet our timelines for renovations, and then getting those units filled once everything's completed and ready to go.
Got it. Got it. So talk to me about actually juggling this and your W-2 along with a family. And I didn't ask you how many children you have. I know you have children, but one children is a handful. 2, 3, and 4, it just multiplies from there. And so, again, you're working a full-time job still. You're in the e-commerce world. You're buying these real estate investments 1,000 miles away from where you're based out of, and you've also got a family to tend to. And so talk to me about how you manage all that.
Not a lot of sleep, Kevin. The primary. No, we have two kids. We're blessed with two. We have a 12-year-old and a 2-year-old, so we have quite a bit of gap. And for us, I think for me, my W-2 job has helped me. Managing operations on a global scale. There's a lot of third-party vendors. It's a lot of larger teams. I have hundreds of people that kind of report up to me during our peak season of the W-2 job, and so I'm used to creating systems and processes, right? And so I've taken those lessons and apply those to our investments, where it's you find really good partners on the ground. You set very clear expectations, and you have really good KPIs. You just hold them to that, and you follow through that. And so it's a once a week meeting that we have with our PM every week. We talk through. Sometimes it's 5 minutes long, sometimes it's 30 minutes long, right? Depends on what we're doing. But that's the thing we have to do, right? And we put those in place. So I despise the reactive management style where it's like, oh, there's a fire, and you focus on the fire, and you could keep kind of tamping those fires down. I prefer to sit there and say, like, what's going to happen, and let's put plans in place to prevent those fires from occurring and make sure that things run as smoothly as possible, because I don't like drama, Kevin. I really don't. I don't like drama shows even, but I much dislike drama in my life as well.
Okay. So a key to this whole process working is the right partnership there locally, and I know that you guys have been building relationships there in that marketplace, and knowing that you wanted to buy investments there, and so you spend a good bit of time um, again establishing those local relationships. And so talk to me about finding the right partner, right? I mean, getting into a partnership is very much like a marriage, and I don't know if you guys are signing on debt together or not, but it doesn't matter. Even aside from that, like, it still is very much a marriage. And so talk to me about finding the right partner. What filter process did you use? Were there some that just didn't make it, that got kicked out, for X, Y, and Z reasons? And if so, what were they?
You talking like investor partners or like
Yeah, investor
property
partner. Yeah,
managers?
like meaning like the boots on the ground guy.
Yeah.
That individual. Again, because I feel like that's a fairly critical aspect here. At least I feel so. Maybe not, but that's kind of how I feel. And so I don't know if you talked with multiple other partners there locally before you decided to go with the one you're with or not. But anyway, would just love to hear some more of your thought process behind that.
No, it's a good question. Yeah, we kicked the tires around a little bit, Kevin, with some other people. But I think as we were looking for somebody to help us in that market, we reached out to our network that we were involved in. And we're like, hey, we're investing in Middle Tennessee, and kind of in the Nashville area. We're looking for people to help us to partner with, maybe sponsor a deal for us, be a KP on a loan, things like that. And we had a couple people reach out to us through our introductions there. I think the thing that we were looking for really was, do they buy into what my partner Mike and I were kind of building to,
Hmm.
right? And we had this vision of like, we're going to syndicate, right? But we're not going to quit our W-2s, right? This is not something we want to transition and become full-time anytime soon. This is something we want to kind of build additional income streams. We have friends and family in our investor network that want to invest in deals. And we have a criteria, right? I mean, we didn't want to buy the 1957 C minus asset that's going to require $20,000 a door, ripped down to the studs to build it back up. And some people wanted that because they're like, those are where the returns are at.
Hmm.
Some partners or some potential partners came in and said like, okay, here's the deal. I want a huge chunk because I'm going to be signing on the loan and I want to exit in less than 3 years. And for Mike and I, were like, this is not what we want. We don't want to transact. We want to build, right?
Hmm.
And then have cash flow and appreciation, but we want to build long-term. And so we were fortunate enough to meet Brandon. He's our partner at a Nashville area. And Brandon had kind of the same vision. It's like, I'm looking for long-term. I'm not looking for a get-rich-quick scheme. And here's my criteria as well. And he kind of bought into it. And I think for us, the cool thing about us is like he helped open our eyes to how to value for valuation, things like that. But we also helped him open his eyes to say like, you can buy a really high A-class asset and make a lot of money on it, because in his past, right, he was buying single family homes that need a lot of rehab.
Hmm.
And so for us, when he came in the Tullahoma deal, the first deal, he's like, wow, this is pretty easy. I kind of like this model after all. And so, he's excited now to keep building along with us.
What are the debt options on properties of that size? I know that Fannie has a small loan balance program, but just maybe speak to those smaller assets that you guys are buying, and what type of debt's available today, and really what the long term plan is with those.
Sure. We did a Fannie Mae loan in the first deal, Kevin, because it was, because of the NOI, things like that, right? We need that 30-year amortization. And so we were able to kind of squeeze into the Fannie Mae loan. So that's kind of a long-term hold for us, right? We like that because it's 10-year term, it's fixed rate for that whole amount of time. We're not looking to refi and roll anytime soon. We knew that it was a longer build. We've been fortunate to kind of beat our business plan because of with COVID, rents have gone up more than we thought, but we couldn't have forecasted that 2 years ago. The other, we have a community bank loan on our second one. That's a really nice deal with Tennessee. We like that because they help to kind of finance a lot of the renovation piece that reduce some of our out-of-pocket capital that we needed up front. And then our third deal actually was bridge debt. It was a non-recourse bridge debt. And so those are three main ones we've seen, Kevin, that work out. I think for us right now, with the valuation being so high, bridge debt seems to be the most common one. Just because NOIs don't support, in a lot of cases, a 70 or 75% loan to value.
Mm-hmm.
So you need that bridge debt to kind of get that term up, or to get the rents up to the point where you can then refi out at a 75% LTV, which is tough.
Have you run the deal that has the bridge debt? Is that bridge debt piece still in place, or have you gone the permanent?
No, it's still in place. So we
Okay.
actually closed that. That was our third deal. We closed in Clarksville, Tennessee. And that was our biggest purchase to date and biggest raise to date, actually. And so we closed that in December of last year. And
Okay.
so we have about 18 months that we promised to pay interest on that loan. That's kind of the terms of it before we can refi out of it. But that was a scary one, Kevin. It was it's floating rates, and we knew that rates are going to be going up this year. Didn't know quite how much, but that was a scary one for us, just because for us it's like only our third deal. It was a big raise, and we had to convince our investors that even if rates were to go up, there's still a really great way to make money on this in the short term and in the long term once we refinance into fixed
Mm-hmm.
rates.
So how is that? Talk to me about that. Obviously, the volatility that we're experiencing with the rates going up, with the 10-year jumping, and ultimately, how has that had any negative impact on the performance of that property? And then, I guess the second part of that question is, how does that affect your whatever the pro forma look like 18 months out when you intend to put long-term debt in place? Is it going to have a negative impact if rates are 6% or 6.5%? Because again, when you bought it at the right time, when before we saw like really big spikes, and ultimately these last 6 months or 7 months have been just an eye opener for sure. So just talk to me a little bit about how you guys plan to overall mitigate the risk with that deal.
Yeah, so I think the thing we did is it was a 3-year term for interest only on the bridge debt. Plus, we had 2 1-year extension options. So we knew that if things were just horrible, we at least have a 5-year runway.
Mm-hmm.
But we also bought a rate cap.
Okay.
So it was expensive to buy, but the rate cap we bought a 2% rate cap. So we know what our maximum interest rate will be. And so if if in 18 to 24 months, Kevin, rates are 7, 8%, well, I should be in the money because we'll be below that with our rate cap, right? And so we have that ability to kind of wait out the storm. And that was a big, big key for us to do this deal. We didn't want to do something where we'd be forced into a refinance or kind of a panic sell
Mm-hmm.
if rates were where we needed them to be for a long-term refinance. So we did that for us. So that was a big one for us. I think as we look at the pro forma, things like that, we underwrote the deal conservatively. We underwrote it like, hey, we're not going to be underwriting. We're not going to be at the current rate we are now. And so we underwrote it at a higher rate. We didn't underwrite at the maximum, but we did the stress test. Like if we hit the maximum pretty fast, what's that do for cash flow? Well, the good news is we're still cash flowing at a positive rate. Are we paying out the investors as much as we initially said? No, we're still paying them out and we're still paying our bills. And we can still run this out for as long as we need to because we
Mm-hmm.
bought a really good asset in a really, really good market. And so that was the key for us. We also knew, Kevin, that even before we closed the deal, that we knew on this third deal that there was $250 to $300 in rent increases available for us without any capex because of just, again, it was a mom and pop ownership. And that had been proven out in those months before we had closed the deal. We had seen the renewals go at the higher rates. And so we knew there was a demand there. And so that's been a kind of a nice way for us to kind of mitigate some of that risk as well, as we know that we're getting the rent increases and we've seen a really big bump.
Are you seeing any vacancies occur or just general pushback at renewals when you're taking something from, call it $700, and bumping it to $900 or $1,000, like really, really big jumps, such as what you just mentioned there? Has there been any outfall as a result of that?
There's been minor, but majority of our property manager on the ground has said most people come back and say like, gosh, I knew you were going to raise my rates. This was such a great deal in this market, right?
Yeah.
So they knew they were getting a good deal. And so when we raised it, we were more than anybody else. We were actually in line or a little bit below what the other places in the market were at, even at our aggressive rent increases. So we knew we were in a good spot. Of course, there are some people, when you go from 875 to 1200, you're going to piss some people off, right? And that's unfortunate.
Yeah.
But we weren't doing this to kick people out of their homes. We were doing it because we needed to make a return for our investors. But it's also, we're actually just raising the rents to what the market was paying at the time.
Yeah, no, it makes sense. And you'd mentioned that, your overall business plan is not to be transactional based. And so, you're looking to, get into these assets and I believe hold for long term. Maybe expand upon that a little bit as far as like, what is the overall business plan? You got investors in a lot of these deals. So, at some point we got to get their capital back to them. And so what is the long-term plan? I know every deal is different than the next, right? But just generally speaking.
Yeah, our standard hold period that we kind of underwrite to is 5 to 7 years, Kevin. So we
Okay.
tell our investors, like at the max, we'll be in it for 7 years. And so we underwrite it with the assumption that we'll hold it for 7 years and we sell it. Now, we also tell our investors if there's a place for us in years 2, 3, or 4, or 5 to refinance it and pull all or most of the equity out for you and then kind of ride it out even longer, we might do that as well too, right? And that's one of the things that we tell all of our potential investors up front is like, what we ask our questions, how long do you want to hold this? What's your plan for this money? What's your expectation for this money, right? If they accept something like, I need the money in 2 or 3 years, then we also tell people like, we're just not the right fit for you because we can't guarantee that. And that's not our model.
Mm-hmm.
And that's why most of our investors are really, they're successful W-2 people, or they're people like that. And what they're looking for really is a really good asset class to invest into, just to build their wealth, just to kind of have that additional income stream, right? They're not looking to retire tomorrow or even next year. They just want additional income streams. And this is a great way to do it with like a
Mm-hmm.
tax deferred potential as well for them, which is nice.
Yeah, absolutely. And so how does one go about scaling? So you guys, I know you love the national marketplace. It's obviously it's a highly competitive MSA to be in. Probably a little less competitive on some of the smaller size transactions, but still there's still plenty of money floating around for those as well. And so how do you intend to go about scaling in that marketplace?
Well, we're working on context right now.
Mm-hmm.
Once you start closing deals, then the brokers know who you are, and so now we're getting a little bit better deal flow than we were even 12 months ago, which was nice. So we're looking through that. We're really talking to people who are in the marketplace as well. Do you know people? Are you looking to sell? That kind of stuff.
Mm-hmm.
It's not rocket science, Kevin. You know that, right? And there is no magic pill where it's like you can just.
I wish there was.
I wish there were, right? Where you can just like you click a couple of buttons in your computer, and all of a sudden you have like 100 great deals. And your problem is which ones not to buy, right? That's not the deal, right? And you're right. There's a lot of cash sloshing around right now in the marketplace. So
Yeah.
I think the challenge for us has been we have our investors on our quarterly calls saying like, "When's your next deal? I have another 50,000 I want to invest." And we're looking, but we're not going to jump at the first thing happening because we want to make sure that it's the right fit for us long term. And right now we're seeing a lot of deals just don't make sense, right? I mean, it's just, we are not willing right now as a group to take on bridge debt because it's so expensive and it's so volatile.
Yeah.
We just don't feel comfortable taking people's money with that. And I know there are some larger people who can do it, but because of our size and where we're at in our current spot, we just don't feel that that's the right fit for our group right now.
I think you might have just answered my question. I was going to ask, and guys, just give you some context here. We're recording this on July 5th. And so, but I was going to ask you, Bernie, if you've seen any, if you've seen the deal flow tick up a little bit more, or maybe seller expectations getting a little bit more in alignment with, the changes in the marketplace. But it doesn't sound like that's the case at this point, or correct me if I'm wrong.
No, you're correct. Yeah, we're still seeing that, Kevin. I think that's, we had a deal come to us. It was a 2-year-old asset in Clarksville, beautiful property. We loved it, but they wanted to sell it for like $215,000 a door. And it was appraising for like 165, 170, which is what we bought our third deal in Clarksville, right? And so we went to our debt financing partners, and they're like going, yeah, I can give you like 55 to 60% loan to value on this.
Yeah.
And that just doesn't make sense, right? And so they're saying, well, go bridge. Well, right now bridge is expensive, as you know, because of the volatility in the marketplace. And if you want to buy a rate caps are like 3 to 4x what we paid for ours back in December of last year. So it just doesn't pencil out for us as a group. And that's, again, there's a struggle with being early in your career, kind of in the stage. And but I think also for us, it's just, we're not willing to swing for the fences right now. I think, Kevin, if I had to guess, I think in a couple of months, we'll start to see a little more realistic expectations come in the marketplace. But until that time, we're just going to wait it out.
Yeah. No, good plan. Good plan. And for those that want to learn, Bernie, more about what you guys have going on, where's the best place to track you down and get more info?
Just go to our website, www.elementalequityllc.com. And Mike and I's contacts are there. We'd love to answer any questions you have.
All righty, Bernie, it's been a lot of fun having you, my friend. Thanks for joining us.
Thanks for the time, Kevin. Appreciate it.
All right, guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. Take care.